Hi everyone, this is Daniel Goott with the Investec Wealth Strategies with a February 2016 market and economic review. In this video, we'll talk about some of the headlines that influenced markets in the last month and can give you some insight into what they could mean for you as an investor. As we are all aware, January was another volatile month for stocks. Investor sentiment turned negative on more bad news out of China and plummeting oil prices. So let's talk about some of the month's major headlines. A first look at fourth quarter economic growth showed us that the economy hit a soft patch in the final months of 2015. Gross domestic product grew just over 0.5%, which is a disappointing drop from the 2% we saw in the third quarter. Q4 GDP growth will be revised 2 more times as data comes in, and it's possible that the final result will be more optimistic. However, we're not expecting a ton of improvement. So why did the economy slow down? Well, we can attribute a lot of the drop to lower business spending and weak global demand. However, the data also shows that U.S. consumers are not spending the extra money they save from lower gas prices. Does the slowdown mean the U.S. is heading for recession? We don't think so. Remember, the economy went into negative territory back in the first quarter of 2014 and bounced back rapidly. In other news, the Federal Reserve met in the last week of January and declined to raise interest rates again. That's not a big surprise given the challenging economic and market conditions, but some experts don't think the Fed made the right call. With so much uncertainty in the markets, a rate hike could have given investors more confidence in the economy. On the other hand, inflation remains low and economic growth is modest, so the Fed might hold off on further increases for months. Earnings season kicked off in January, and the overall picture is one of lower earnings and lower revenues. That's not a surprise because we know that American firms are facing major challenges from the slowing global economy, a strong US dollar, and weak commodity prices. But more than 2/3 of the firms that have reported so far have been able to beat their earnings targets, which tells us that managers are doing a good job of managing expectations. On the positive side, a gauge of manufacturing activity blew away expectations and came in at the highest reading since last January. Manufacturing, which is a backbone of economic activity in many parts of the United States, seemed frozen after several reports showed that factories struggled with demand. This new data is a refreshing change, and we're hopeful about manufacturing this year. That's it for the February update. As always, if you have any questions or concerns about what we've discussed, or anything in general, please give our office a call at 713-622-9111. Once again, this is Daniel Goott with Investec, signing off for the month of February 2016.